The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box Europe. I'm Karen Cho with Steve Sedgwick and Juliana Tattlebaum. These are your headlines. Nvidia posts a third quarter beat and guides above expectations for the year ahead, lifting shares 5% in after-hours trade. The CEO, Jensen Huang, looks to ease concerns around stretched AI valuations.
There's been a lot of talk about an AI bubble. From our vantage point, we see something very different.
Well, as you would expect, a relief rally sweeping through global stocks and Bitcoin for that matter, sending Asian chip makers now higher. Futures in Europe and on Wall Street pointing to strong opening gains.
And President Trump ramps up his criticism of Fed Chair Jerome Powell and calls on Treasury Secretary Scott Bessent to help him bring down rates.
You got to work on him, Scott. The only thing Scott's blowing it on is the Fed. Because the Fed, the rates are too high, Scott. And if you don't get it fixed fast, I'm going to fire your ass, okay?
We're going to get straight into the weeds on Nvidia today as the shares jumped in extended trade after the AI giant beat on third quarter expectations and delivered guidance ahead of analyst estimates. The company saw earnings jump 65% on the year and revenue rose 62%, while guiding for current quarter sales of $65 billion. That's around $3 billion more than analysts had expected. CEO Jensen Huang said sales for Nvidia's advanced Blackwell chips are, quote, off the charts, with demand for AI compute continuing to accelerate. Huang used the company's earnings call to sound a bullish note on the state of the tech sector after recent concerns around valuations.
There's been a lot of talk about an AI bubble. From our vantage point, we see something very different. As a reminder, Nvidia is unlike any other accelerator. We excel at every phase of AI, from pre-training and post-training to inference.
Chip makers across Asia have also taken off, and you can see big gains across the board. Some of these companies doing business with Nvidia as well, so those links are there. And you can see gains in the order of 5% for the likes of Tokyo Electron. I want to get into what we saw, the positives here. I think we already knew a lot of the positives before the numbers yesterday. 500 billion, the number in terms of orders that had come through just in recent months. So a huge amount of demand there. Jensen Huang himself talking about being absolutely everywhere, almost monopolistic style of comments here, but saying that was a positive because effectively the technology works. For me, the negatives were still there. They were hiding in plain sight, that you still got the amount of renting back of capacity from Nvidia, that underutilized capacity from some of the companies, CoreWeave, for instance, one of those that it does business with. So those are still concerns about where you see that circularity. Concentration risk, there were still 4 major customers accounting for 61% of sales. That is still a danger for the markets. The circular deals that we've been talking about, where they're investing in other companies like OpenAI, Anthropic, and then those customers are wanting compute power. So I think some of those dangers remain.
I think the comments on China also interesting. I mean, Nvidia was reluctant to give any guidance around China in the previous quarter, and now today you've got Nvidia saying that sizable purchases never materialized in the quarter due to geopolitical issues and increasingly the competitive market in China. And we've been discussing how the Chinese government, even though now they are able to purchase, Chinese companies are able to purchase some of these chips, they're steering their companies away from Nvidia.
Let me just meld a little bit of what you're both saying. I see every reason in the world why people are excited about Nvidia. Every reason in the world. They were phenomenal figures. I see zero reason why anyone should buy any other stock on the back of this. I see zero reason for Bitcoin to have rallied $2,000, $3,000 on the back of this as well. It says to me, and it's alluding to Karen's point, I think, that there is every reason in the world to see that the monopolistic player in GPUs on a global basis is in a stunning position with enormous margins on enormous sales. I see nothing that says from these figures we aren't in a bubble. In fact, if anything, I think it exacerbates the bubble concerns because the concerns aren't whether Nvidia can sell a lot of chips to people who are desperate to ramp up their AI capacity. The concern is whether those people will be able to monetize it, and as you say as well, the concerns over the debt being attached to that. That for me is it. Nvidia, knock your socks off. This is clearly the standout winner of AI at the moment. I see nothing in this as well that tells me all those clients are going to do anything other than spend a lot of money on something they just don't know yet whether it's going to be monetized.
It's a very, very good point. How much can we actually extrapolate here from these numbers? Let's take a look at U.S. futures and see what the market is saying. We are looking at strong gains across the board. The NASDAQ looking to open 450 points higher. So clearly investors are taking comfort in what they heard from Nvidia after the close yesterday. You're looking at the Dow adding back more than 250 points, the S&P adding about 87 points. So very strong indication across the board. In terms of European futures, here's your early look at what's in store for the trade here. You're looking at gains in Europe as well, more contained in terms of the magnitude, but green across the board nevertheless. Let's welcome Hugh Gimber to the show, global market strategist at JP Morgan Asset Management. Hugh, great to have you with us this morning. Let me kick off with Nvidia for you, not specifically the numbers themselves or your view on Nvidia, but what do the numbers, do you think, mean for a broader market sentiment?
Yeah, I think what we learned last night is that the company has executed incredibly well, but I don't think we learned a huge amount about future demand because their order book is so far out here. We know for a long time Nvidia has been the most popular chip for many companies to be buying. And so for me, the market reaction was telling you more about the building investor concern that we've had into these numbers and some relief that nothing really went wrong, rather than any incremental new news about the path into 26 and 27. For me, where we're going to get that sort of incremental news is more likely to come from outside of the technology sector. Because through the earnings season, what we've been spending more time on, to be honest, is where are we trying to track end demand coming from healthcare, from finance, from manufacturing, that can start to fill this AI ecosystem with the profits that are going to be required to be shared out among the major players. It's a bit like the supermarket, right? You go and do your weekly shop, you spend your £50 or whatever it is, and you need that money to be able to cover all of the different players that are involved in the supply chain. At the moment, we have the Nvidias, we have the hyperscalers, we have the LLMs working well, but we still don't have enough visibility on the money that's being spent at the till.
Well, I was just to say, we've learned one thing, that you clearly don't do the weekly shop.
Well,
because if you think it's 50 quid, then you're in the wrong planet.
I'm a frugal
I want to
man,
shop where the
Steve.
Gimbers shop, I'll tell you that much. All those other constraints, I alluded to one of them, which is the debt attached. The other one, there's a great, dare I say it, Barclays report out this morning talking about the need for the energy as well. I see all kinds of bottlenecks and problems, not with Nvidia, not with the demand for chips from hyperscalers, but elsewhere in the ecosystem.
And that's what we're still grappling with. We've been spending a huge amount of time over the past month trying to get our hands on all of the available data to look at end demand, whether that's some of the survey data, whether that's the Census Bureau, whilst we were still getting those numbers. And lots of this data paints a fairly contradictory picture. Ask companies, are you using AI to produce goods and services? Only 10% of them today will say, yes, we are. Look at their invoicing data. Are they spending money on LLMs to try out this stuff? About 45% of them are. And so you're looking for the bull case, you're looking for the bear case, and frankly, at the moment, you can find data that backs this up, which is where we're saying to clients, first of all, within these tech themes, you can't know today whether it's Nvidia, whether it's AMD, whether it's Broadcom that in 5 years' time are going to be the ultimate winners. So you've got to be diversified across the different parts of the ecosystem. You've got to think globally. We don't know where China sits in this and how long the US giants are going to remain ahead. And then you've also got to think about private markets, because if the 2000s taught us one big thing, it was that sometimes the big winners of these types of trends don't emerge for several years, and we may not be aware of the names that are ultimately going to be looked back on as the big AI winners.
I take your point about scraping through some of the commentary from the rest of the companies reporting about the demand story, and we've been doing the same effectively. I mean, we were asking Aviva the other day about the use cases and how they're about to scale. But something that came up yesterday again, as we talk about no execution error at all from Nvidia, and you think given the amount of demand coming through, that would be an issue, but no issue producing those GPUs. The middle part here, you spoke about the supermarket story, the customer, but also the end part, the warehouse, the logistics. What about the road? What about the truck? getting the product to the customer. And to me, that's what's come up here, that there's no shortage of demand. In fact, the hyperscalers are going to be ordering these chips, and they're going to be ordering them in the millions. The problem could be in the middle part with the grids, with some of the land, the access to some of this data, this grid access. Do you think that could be a problem? All those sticky bits in between that we think is an issue in the backdrop. Utilities, of course, we've seen the trade go on. But could that be a greater issue than we're thinking about at this stage?
For me, that's an issue of timing rather than the end destination. When we're thinking about how quickly companies can get access to the compute that they're looking for, yes, all of those constraints that you described, I think, could bite over the next couple of years. I still come back.
Hence the digestion issue, though.
Hence the digestion issue, which is why I come back to last night's results being more about execution rather than a signal of future demand. But this is where, ultimately, I think it does still depend on the demand that is required to fill the profits of all of those within the system. For the last 3 years, that demand has been insufficient, and therefore the hyperscalers have been footing the bill. Microsofts of the world have been saying, our businesses elsewhere are profitable enough that we can continue to foot the bill for others. That only has so far to run. And so every earnings season at the moment, clearly the tech giants' results are in focus, and rightly so, given their share of the market. But it's all about, for us, where are we finding demand from other sectors to justify the spend that's being put in place today?
Hugh, in terms of the market action we've seen in the last couple of weeks, until yesterday, the big debate was whether we were actually seeing the beginning stages of the end of the bull run. Now, quickly, sentiment has changed. But how much of the jitters that we saw in the market were actually linked to the AI trade, linked to Nvidia, versus the Fed? Because that's the other big question mark here. And when I look at the latest news flow around the Fed, including the Fed minutes that we got yesterday, I think the rate path looks increasingly less clear, and it's a less of a sure thing that we're going to get more cuts near term.
Yeah, I think you can describe the Fed's position here really through the word of optionality. Powell, at the most recent meeting, did not want to be backed into a corner feeling like he was under pressure to deliver a December cut. The minutes gave us that same message yesterday. Ultimately, though, big picture here, the next move for the Fed on rates is down. We're talking a lot with clients at the moment about the fuel that's going into the economic engine. That's what we're calling our 2026 outlook, fuel in the engine, because of the amount of monetary stimulus and fiscal stimulus which is being delivered, frankly, at a time where the economy doesn't really look like it needs it. If you just follow US data, again, of what we have at the moment, there is no immediate need for lower interest rates. There's no immediate need to be running fiscal deficits as if we're deep in a recession. And yet that is what we have in the US, it's what we're seeing elsewhere around the world as well. And so I struggle to justify the market suddenly seeing a totally different path for next year based on whether or not the Fed cuts in December. If it's December, if it's January, I really don't think it matters for the equity story. What the markets need over the course of the next 12 months is the knowledge that policy is still working on their side. And that's what we think we have, lower interest rates and more fiscal stimulus powering this economic expansion.
Do our viewers and your clients have a better entry point in the next month or so than the current levels?
I think that's an almost impossible question to ask, Steve, and I don't know.
But it hasn't stopped the brightest and the best, and I'm sure Jamie's been out there as well doing it.
Of course.
Opining about the need for a correction on markets.
Yes. I mean, how long have we been saying, wouldn't you like to buy the stock market 5% lower, 10% lower?
Yeah, but the problem is when it is 10% lower, they don't want to buy it. They only want to buy it when it's at the current level.
Of course. From our perspective, what we would be thinking about now, where can you get into the market today with valuations that are reasonable and with decent visibility over the medium term? So take something like Europe as an example. You do not have to be second guessing all of the questions we've just described around end demand, where frankly the answers today are still very opaque. You can look at the German fiscal pivot. You can look at the improvements that we're seeing in bank earnings. You can look at a market which is reasonably valued and say, I can take action there today, particularly if I'm looking to diversify away from a very US-centric global equity market. I don't think that requires a 10% dip to be able to say, yeah, I can see value. Similarly, in defense-related names globally, yes, they've had an incredibly strong run, but think about the fiscal support, the fuel in the engine that we're going to be seeing backing that sector in 2026. I don't think you have to be waiting there. So if you're trying to get more access to AI and to this year's winners, possibly you are waiting for a bit of a correction to try and take a more tactical opportunity. We'd be thinking, where can you act today that doesn't require that valuation adjustment.
Hugh, let me round out the conversation and ask you about one of the fears that the market has. I've been pointing out it's the AI bubble, but there's also concerns around the data as we waited out for the September payrolls report. There are concerns around the IG market, which could be the trigger. If we see any weakening in the economic data, it could be some sort of feedback loop to the IG market where some are short, some are now positioning out of IG because they're concerned that the spreads are not truly reflecting the risk. Do you have concerns around IG as well?
So I would put the investment grade market, to be honest, I put the high yield market in a similar place in that you probably are waiting for some spread widening to find better opportunities. Because when you're looking at markets in the world which are priced for this economic perfection, really, credit seems to be the most obvious place to look, where spreads are exceptionally tight, justifiably so to an extent, given the strong position of corporate balance sheets, but the risk reward there does not appeal to me that much. When you think about your options that you've got marrying equities and higher quality government bonds for next year, for example, that feels like a better mix of risk reward than trying to eke out incremental returns in credit. Obviously, for the fixed income constrained investors, for the insurance names, for example, there are still going to be seeing strong demand for high quality credit. But ultimately, if you're an unconstrained multi-asset investor, I think you're better positioned in equities with further upside, with earnings doing the heavy lifting next year.
Lovely to see you. Thanks for coming in nice and early to see us as well. Hugh Gimber, who is Global Market Strategist at JP Morgan Asset Management. And by the way, thank you to all our viewers who are writing in with interesting messages this morning, lots of Christian and Gary already. I will get back to your emails as soon as I can. Thank you. Coming up on the show, one of the most eagerly anticipated non-farm reports ever. Well, we're only going to get a little bit of it, aren't we? We look ahead to the September jobs numbers, but not a full set of other data as well. Plus, European banks and financials have been touted as a hedge for next year's volatility. Wow, okay. Charlotte is on the ground at JP Morgan's financials conference. Can you have too much JP Morgan in one show? I don't know. And Nvidia earnings beat forecasts. But what should we take away from the report after weeks of heightened concern over an AI bubble? Dan Hambury, Global Equity Portfolio Manager at 91, will join us to discuss. Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
Business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that a society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
Euronext says it has completed its voluntary share exchange tender offer for Athex, securing just under 3/4 of the Greek stock exchange's voting rights. This is part of the bourse's campaign to consolidate the continent's capital markets in a bid to help alleviate the fragmentation it says is hurting Europe's competitiveness with the United States. Stefan Büchner joins us, the CEO of Euronext. Stefan, always great to see you. Last time we had a broad discussion about the idea of one stock exchange in Europe. This was an idea put forward by the Germans. Now we're seeing consolidation again by your company, trying to bring together the exchanges. What does this do in terms of conquering some of the issues where European stock exchanges are much smaller than the US?
Well, some European stock exchanges are much smaller than the US, but what we have built over the past 25 years, in particular over the past 10 years, is something where the numbers are compelling in terms of liquidity. We have a single technology platform, a single order book, a single liquidity pool. This liquidity pool trades every day something between 11 and 12 billion euros. The aggregate market capitalizations of the companies listed in this single integrated European pool of liquidity is above 6.5 trillion euro. This is more than twice the size of the London equity market. It is more than 3 times the Frankfurt equity market. We have built the largest liquidity pool for equity in Europe. Yes, it is still smaller than the US, but yes, it is already the largest liquidity pool in Europe. That's why we attract more international IPOs than others, because we have decided that equity does matter. Other exchanges have decided that equity doesn't matter as it used to do. and have decided to diversify away. We are diversifying, but we do consider that the purpose of a market infrastructure is to connect local economies with global markets and to power global markets to finance the real economy. Now, that's why we are been successful so far, and that's why the integration of Greek capital markets and Greek stock exchange and Greek market infrastructure within the Euronext family is so important, because it shows that we do capital market union for real.
Does it also suggest that there is a coming of age again for Greece itself? If we reflect back on several years ago, there would have been perhaps some pushback about further integration of Greek assets because of where Greece was. Some of the fragmentation was really triggered by the weakness we saw in these peripheral European countries.
Thank you for asking this question, because this city has invented back in the days, 15 years ago, the concept of pigs. You remember the famous concept of pigs, Portugal, Ireland, Greece, and Spain. Today, Greece buys or borrows for 10 years bonds at something like 3.3%. The UK borrows around 4-point-something% for 10 years. France at 3.4%. So all those pigs country borrows for 10 years at a cheaper price than France and the UK. So the Greece is going to celebrate this year either the second or the third year of budget surplus, which is a dream for both the French Minister of Finance and for the UK Chancellor. So I think the reality of Greece being back because of all sorts of reforms implemented over the past few years, and in particular because of the huge efforts done by the Greek society over the past 10 years, is something amazing. That's why we believe that it is the right time to invest in Greece. This is an amazing economy, a society which is unbelievably open to globalization and to the rest of the world, with great talents, and we are very happy to start embarking into this journey with them.
Lovely to see you, and thank you for explaining the rationale for it. By the way, I always hated that acronym and always tried to not use it. I thought it was derogatory and just very dismissive.
And it was insulting as well.
Unbelievably insulting. I could not agree more. And I think it was a Northern European one, let's be brutally honest about it, and I thought it was awful. Stefan, let's not beat around the bush. It's time for one single European bourse, isn't it? So that we can power ahead. It's time for a lot of single European things, but we're working in different stages as well. When are you and Deutsche Börse going to become one?
I mean, M&A is a consenting adult game. You need to do a deal, a willing buyer and a willing seller. We are a willing consolidator of European market infrastructure, in particular in the equity space where the need is. I mean, the need for consolidation is above all in the equity space, because that's where liquidity matters the most. And that's where the antitrust issues are behind us. So we are available, and I've said that on many occasions, to explore consolidation of equity platforms, because we have the basic tool, we have the processes, we have a pan-European culture, we have the supervisory framework, we have everything that is needed to do that. But you should not ask me the question, you should ask the question to Deutsche Börse, because there is this joke, and sorry for onboarding jokes in this conversation. The guy who says, I'm going to get married with the daughter of Rothschild, it's done 50% because I agree. So that's exactly the real answer to your question. I mean, it's a combination exists between consenting adults. We are a willing buyer. I'm not sure there is a willing seller.
So when it comes to André Ochel trying to buy Commerzbank, we know the German establishment from the government down, whichever government it is, both governments, nah, we're not going to do this. But when it comes to the comments I've seen from Chancellor Merz about a pan-European exchange, that looks a lot more encouraging. So I'm going to ask you a very blunt question. Have you and Stefan Leithner had serious conversations at all about the creation of a single bourse?
No.
None at all?
No, not at all. And I had in the past with Theodor Weimer this type of conversations, but not with Stefan Leithner. Okay. And what you need to understand on the occasion of this topic is the profound federal nature of Germany. What the Chancellor says is important, it's immensely aspirational. What really matters is not so much what the vision in Berlin. What matters are the decisions in Frankfurt within the boardroom of Deutsche Börse, and what is happening, the decision taken in Wiesbaden at the government of Hesse. For certain matters, Germany is incredibly federated, and you should think about some federal states' power and decision-making authority for certain matters, as this one, like this one, as you think about the Helvetic Confederation with very strong power at the local level for certain matters. So that's why from the outside we tend to sometimes struggle to reconcile the vision in Berlin from the Chancellor, who by the way has a sort of personal strong finance background and who understands those things with intimacy. And on the other hand, the fact that the decision makings are in the boardroom of Deutsche Börse in Frankfurt and in the government building in Wiesbaden of the Land of Hesse.
Stefan, it's very clear listening to you that you are keen to double down on equities, that you're keen to remain a pure exchange versus some of your peers who've gone down the diversification route you alluded to earlier, expanding into data and analytics.
Sorry for interrupting. We are not targeting to remain a pure exchange. We are not a pure exchange, but we are trying to grow and expand and to diversify away from pure trading businesses, but we don't give up, we don't neglect, and we are committed to continue to build in Europe an exchange platform, because we do believe that large issuers in Europe need a local European, pan-European liquid equity markets. But we are not, we do appreciate that we need to diversify. By the way, the valuation multiples of my peers who have decided that equity is a sort of legacy secondary priority have valuation multiples higher than mine. So the markets encourages them to abandon equity.
Let's squeeze one quick one in.
Does that mean that you are looking to make acquisitions in the areas of data and analytics, for example? Sounds like you are looking to expand and diversify.
Well, diversification doesn't mean only data and analytics. Back in the days, 5-6 years ago, everyone was saying data is the new oil. And now everyone is saying data is going to die because of AI. So my approach of all these themes is the British phrase, keep calm, okay? Data was not the new oil. Venezuela is a great oil producer, so keep calm. And AI is not going to kill them all. Keep calm, okay? Be granular in your analysis of these themes and buzzwords. The reality is that we want to diversify. We have diversified. 60% of our revenues have nothing to do with trading volumes. Actually, within trading volumes, only a smaller part now is equity trading. The half of it is fixed income trading, in particular in govies with MTS, where the business is 4 times bigger than what it used to be when we bought it. In forex trading, in energy trading, in commodities trading, in particular in wheat and corn, etc. So we are diversified in trading, 40% of our top line together, including equity, and 60% has nothing to do with trading, and it's post-trade, it's technology, it's corporate solutions, etc. But the difference with the others is that we don't believe that equity trading is a museum. We have found a recipe to make equity trading profitable. So that's why we are happy and we are willing to welcome equity trading platforms in Europe that want to join this amazing success.
We've got to let you go, but why do I feel half your answers are about David Schwimmer? Thank you. I'm kind of just saying equities is on the side rather than about data and things.
No, I have a huge respect for what David Schwimmer has accomplished. I think he's an amazing leader in our industry. I think there is a sort of disproportionate perception of the impact of AI. It's too simplistic to say 5 years ago data is everything and now AI is going to kill us. It's not. It's both. It's not unfair. We don't care about fairness, but we care about being accurate. It's inaccurate.